Trump is imposing so many tariffs that entire industries seem ready to tumble. Stocks are in free fall, and whispers of a huge market crash echo across the country. But what exactly is going on behind the scenes? Why does almost no one seem to understand the real cause of this looming disaster? This may sound like a stretch, but think about what happened in 2008, when most people saw the obvious signs of financial disaster and ignored them. That's exactly what's happening today. And if you ignore the signs this time too, what's coming will be devastating for you and your family. And the only way to prepare yourself is to watch the video until the end. Let's get started. For years, the United States has been spending more than it earns, digging itself into a colossal hole. That hole is now over $36 trillion deep. This number alone doesn't tell you the full story, because it's not just about paying back that debt. It's about the giant interest payments that grow larger every day. The government can keep borrowing, sure, but each new loan raises the interest bill even further. If this cycle doesn't slow down, the country could end up devoting half or more of its tax revenue just to pay interest, leaving precious little for roads, schools, and social security. Yet in the public sphere, we hear mostly about short-term events, a tariff here, a new budget deal there. We rarely see how they connect to the bigger, more frightening truth. Trump's tariff policies might seem random or even self-sabotaging on the surface. Businesses complain that these measures disrupt supply chains, raise consumer prices, and fuel market chaos. Corporate earnings suffer, spooking investors and causing stock prices to drop. If you check your portfolio or retirement account, you might notice the downward trend. But the real question is, what hidden crisis is the administration trying to address with these tariffs? Are they just an aggressive negotiating tactic? Or do they represent a last-ditch attempt to rebalance the United States' dependence on foreign goods and offset the mountainous debt? Those in power likely won't admit it directly. They prefer to talk about unfair trade practices or protecting American jobs. But behind those words looms the simple fact that the country can't keep hemorrhaging money to foreign nations indefinitely. Plenty of people believe the US economy can just keep printing dollars, or that the dollar is too big to fail. That assumption could be fatal. The global appetite for US debt, which used to be almost limitless, has shown signs of shifting. Emerging powers are forging currency pacts that skip the dollar entirely. Even some historic allies are hedging their bets. If foreign investors become less eager to buy US bonds, the Treasury will have to offer higher interest rates to attract them, driving the debt spiral deeper. We've seen small echoes of this in the bond market, but the day real panic sets in might change everything in a matter of weeks. Critics who dismiss these fears argue that the United States has faced deficits before and recovered, but never on this scale, and never with such complex global tensions. Think of the domestic economy like a household that's been living off credit cards. If the credit card company keeps raising your limit, you can carry on for a while, but eventually the interest consumes you. The hope is always to earn more in the future to pay off the loans. But that future date keeps getting pushed back. Meanwhile, you're in deeper debt than ever, with a monthly interest bill you can barely handle. If a single paycheck falters, if a recession hits or your credit score plummets, your entire financial life could collapse overnight. Now multiply that scenario by trillions of dollars to see what the US is facing. The tariffs, ironically, could speed up inflation as foreign producers pass along the added cost. At the same time, they might push some manufacturing back to the United States, theoretically creating jobs or propping up domestic industries. But that's a gamble. If the new costs outpace any gains, or if trading partners impose retaliatory tariffs, entire sectors of the economy could face brutal layoffs and plunging consumer demand. That, in turn, would shrink the tax base, making it even harder to service the massive debt. Some say it's a choice between a slow decline or a short, painful shock. Either way, Americans aren't being told the real reason behind these extreme maneuvers, the fear that time is running out to rein in the debt before it topples the system. The approach to solving the debt problem is messy. One path is to slash government spending drastically, but that's politically explosive. Politicians who propose major cuts to entitlements like Medicare, Medicaid, or Social Security risk losing the support of millions of voters, especially older citizens who rely on those programs. Another path is to hike taxes aggressively, but that also stirs public anger and could stifle business growth if not done carefully. Then there's the Federal Reserve's role. If it tries to combat inflation by raising interest rates, borrowing costs surge for everybody, from individuals to large corporations, and especially for the federal government. The debt burden becomes heavier, even if inflation stabilises. So the Fed might decide to keep rates lower for longer, but that can weaken the dollar and fuel more inflation. It's a treacherous balancing act. A few government insiders, economists and investors are alarmed enough to plan for worst-case scenarios. They buy alternative assets or shift to safer harbours outside the dollar. They move into gold, crypto or foreign stocks, anything to avoid being locked into US bonds or bank accounts if a meltdown arrives. But these manoeuvres quietly feed a sense of uncertainty. Meanwhile, the average citizen is still unaware. They watch the headlines about trade wars with China or the European Union. They see passing references to national debt, but they don't grasp the full scale. Many wonder why every new budget feels like a short-term fix with no real strategy. The reason is simple. A real fix would be radical, unpopular, and possibly brutal in the short run. No politician wants to shoulder that blame. Imagine a scenario. Within a few years, interest on the debt reaches unthinkable levels. Suppose rates jump, the economy slows, unemployment rises, and the government tries to maintain its obligations anyway. To keep borrowing, it must pay even higher rates, so the deficit balloons further. Suddenly, an agency like Moody's or Standard & Poor's decides to downgrade US credit. Overnight, the cost of refinancing or rolling over existing debt skyrockets. Panic hits the bond market. The stock market follows, as big companies see their lending costs jump and new investment dries up. Before you know it, the government is forced into crisis mode budgeting, slashing spending across the board, freezing certain payouts, maybe even floating the unthinkable idea of partial default or forced restructuring. The global ripple effect would be catastrophic. If you think that's a wild exaggeration, recall that no one expected the 2008 crash to spread so quickly from subprime mortgages to the entire banking system. High-risk instruments, hidden in plain sight, triggered a chain reaction once panic set in. Today, the hidden in plain sight instrument is the US national debt. And those who see the writing on the wall suspect that Trump's aggressive tariffs might be an attempt to force the world to buy more American products, thereby reducing the trade deficit and, in theory, lessening the country's dependence on debt. But it's a long shot. If foreign nations refuse to play along, the US might simply end up damaging its own economy by raising prices at home and losing valuable export markets. The debt would remain, bigger and nastier than ever. The truly frightening aspect is that nobody wants this reality to go public. Both political parties in Congress have a vested interest in keeping spending high, one for social programs, the other for defense and tax cuts, so the debt keeps climbing no matter which side is in power. Meanwhile, the media focuses on short-term controversies, ignoring the slow-motion train wreck happening right in front of us. People go about their daily lives, caught up in minor market corrections, oblivious to how quickly the situation can spiral. So what can you do? You can't single-handedly force the government to slash the debt or rework its entire fiscal policy, but you can position yourself so that if the worst scenario occurs, you won't be left holding worthless paper assets. At a minimum, diversifying your portfolio might help. Some choose to hold physical gold or precious metals. Others consider foreign currencies or stable multinational stocks. A few risk-tolerant individuals explore cryptocurrencies, though those come with their own volatility. If you stay solely in dollar-denominated bonds or rely entirely on a single US employer that could fold in a recession, you leave yourself vulnerable to a sudden crisis. You might also evaluate real estate, though that's not a guaranteed haven if the broader economy collapses and mortgage rates surge. A second key step is maintaining liquidity. If a meltdown strikes, banks might tighten lending. Having access to cash or equivalents could spare you from having to liquidate assets at fire sale prices. It's also wise to keep an eye on interest rates, inflation, and global shifts in currency alliances. If emerging markets or major powers like China and Russia move away from the dollar for trade settlements, that's another sign the clock is ticking faster on America's debt viability. Ultimately, the main point is that the spiralling US debt, combined with trade tensions and uncertain monetary policy, creates a precarious environment. Trump's tariffs are just a flashy symptom of a deeper crisis. An overextended empire that depends on borrowing is trying to claw back control by strong-arming other nations into playing by its rules. It could buy time, or it could backfire spectacularly. No matter how it plays out, ignoring the problem won't make it disappear. The national debt isn't merely a talking point for election cycles, it's a fuse burning down. And if you don't prepare, you could get burned. Yes, the meltdown might not happen tomorrow, but every day that passes without addressing the core problem shrinks the window for a soft landing. Politicians keep hoping for a miracle wave of growth, but the current global slowdown hints that might not arrive soon enough. This is why paying close attention to policy changes, central bank announcements and market signals is vital. A sudden shift in investor sentiment could happen overnight, unleashing chaos. By then, it will be too late to move your assets or rethink your job situation. So let's recap how to survive this catastrophe. First, protect yourself by diversifying into assets that won't vanish if the dollar weakens or if tariffs lead to severe stagflation. Second, build a safety net of savings or liquid assets so you're not forced to sell investments at the worst possible moment. Third, keep informed. Knowledge is your armour against misleading headlines or empty promises. If you monitor the key metrics like bond yields, federal spending and trade balances, you'll see warning signs before the masses do. And that could be the difference between seizing an opportunity and losing everything when the house of cards eventually collapses. No one can promise a perfect outcome. The system is too large with too many variables, but ignoring the danger won't save you. The best you can do is face the truth, adapt your strategy, and stay vigilant. Because once the curtain falls on this $36 trillion drama, those who prepared might come out stronger, while everyone else will be left wondering how they missed the signs. And as soon as there are updates on this issue, I will immediately make another video to update you, but only if you like the video. Let me know with a like and comment. And above all, do not forget to subscribe to the channel so as not to miss the next videos. The future prospects of our nation are not good, but I will always be here to give you the best advice to save yourself from these catastrophes. And I'll see you soon.